We're going to do a brief video on technical analysis, moving average trading strategy. And what we're going to do is set this up exactly the way I would do it before I normally record these videos to show you what I do. The first thing you need to do is get yourself access to a charting program. This one's from TradeView, and you can get it for free. You can go over there to tradingview.com and get it for free and set yourself up with a good trading service like this one. And again, this one's free. But first, what I'm going to do is put on 3 moving averages, and then I'm going to customize them. And the colors that I use are my own. I've done it for years, but you can use whatever colors you want. The first one is we're going to put a green 5-day on here. And the next one, we're going to put a red 20-day on here. And if you're consistent with the colors, you don't get confused over the many years as you learn this. But I'm going to finally put in a blue 200-day. Now, you can play with these all you want, but at the end of the day, there's no magic. You're just trying to get what everybody else is using so that it's consistent. If you're building algorithmic trading systems, and I'll show you one of those in a minute that we built with moving averages. If you stick with us to the very end, I'll show you how to get it all for free. But right now, it's important to keep in mind that unless you're building an algorithmic trading system, a 520 crossover system is a classic moving average crossover system. And it's classic because it works. And there's some limitations to it, and we'll go over those in a minute. But this technical analysis moving average trading strategy is basically broken down into several parts. The first parts are, what are you using the moving averages for? And in general, you use the moving averages to tell you whether you should be short or long. Now, most people who trade stocks don't short stocks, but you can always go short with a put option on stocks. So you don't necessarily have to use the instrument. We set this up on Apple, but you could use Apple options. You could use options on the S&P 500, which are a fantastic way to trade options. And if you use options, you can go long or short with options. You could go long the stock, short the stock with options. So there's a lot of ways you can play this. But the important thing to keep in mind is moving averages are not usually going to give you a specific price to get in the market. They're just going to keep you straight in terms of being long or short. And they're also going to give you some timing, but not really the finest timing in the world. But we'll show you in a minute exactly how to compare the two from a technical analysis perspective and a quantitative analysis perspective. But for our purposes here right now, let's just take a look at this stock. Now, the first thing moving averages do is they give you perspective. They show you what's going on, and you can go back as far as you want. We can crunch this down, and in a very short period of time, we can see something about this stock that most people couldn't see if they didn't have a moving average on there. Let's go all the way back to June 2019. The first thing we notice is this Apple stock respects the 200-day moving average. So what do I mean by that? I mean that when it encounters it, it typically stops and turns around and goes the other way. So we can see that if we start right here, the stock was in a bear market through this section here and started flirting with the 200-day moving average around March of 2019. You can see it went up and down, and then it went above the moving average and started a bull market. Anything above a 200-day moving average is a bull market in a stock. So we did two things here. We showed that this stock respects the 200-day moving average, and it also respects the 20-day. Look at this 20-day moving average. You could have gone long this stock and just stayed long almost the whole time. Now, this would have given you, it's not perfect. This would have given you a little hiccup. But you could have gone long this stock at about 50 and stayed long to about 67, taken $17 out of this stock, and your only decision would have been, has it closed below the 20-day moving average? So that's a first simple example of how to do technical analysis and a trading strategy using moving averages. You just do it by eye. Now, is that the way we do it? No, but we'll show you how we do it in a minute. But if you spread this out, you can see, once again, you could have got out of the stock, taken some profits, wait for it to get above it again, get back in it, and again, just ask yourself every day, has it closed below the 20-day moving average, which is in the red? No, so you just stay with it until it finally does. It did right here on this day, the 20th. So you would have gone from roughly December 10th to January 20th, and you could have pulled out roughly another 15 bucks out of the stock. Now, you may say, hey, I'm not a short-term trader, no big deal. That's fine. You don't have to use it that way, but that's one way a lot of people use it to keep you straight, and you're not doing a whole lot of thinking there. Now, once this stock has respected the 20-day for quite a while, and you see distribution at the top, which you see right here, you see this widening of the daily, expansion of the daily range, and you can see this stock here that I'm highlighted on had a $3 range, this stock right here had a dollar range, not even, about 70 cents. So once the range starts to expand, this is distribution at the top. We're going sideways. It's your time to get out of your stock. And moving averages can show you the slope changed from this aggressive slope to a more refined slope here, and then eventually it rolled over. You wanted to think about getting out of the stock right here. Now, it can take years to learn technical analysis, and I'm not trying to teach it to you right here tonight. But the important thing to understand is, where's the price relative to a 20-day moving average? Is it above it? Then you're probably safe to be long. Is it below it? It's probably safe not to be long. It's probably safe to be put options, buy some put options or get out of it completely. Simply by understanding that a 20-day moving average is respected by a stock, and you can do that by just looking at it. You can see that this stock historically respects a 20-day on both the upside and the downside. You can just look at it. So that's the first great thing about moving averages. The second thing is you can really get an idea of what this stock is doing in terms of its overall bull or bear market if you put a 200-day on there. The 5-day is usually something you can use as trigger to get you in, and I can show you that in a minute. But when you're talking about should I be long or short, you're typically looking at a 20-day. Where to get long or short specifically, you can use a 5-day, and I'll show you how to do that in a minute. But let's take a look at this 200-day. We can see long-term, this stock came up, came down to the 200-day, tested it, rallied up, came down, and that's a very important thing to understand about a 200-day moving average. When you begin to see this area under the price but above the 200-day widen, that's a really good idea that this market's getting ahead of itself. It's going to correct. Look at how much this space widened. Think of it as a triangle. When this base of this triangle expands, it's getting dangerously high, and you're going to get a correction. Same thing here. We stayed pretty consistent through here. We got too high here. The distance got too much, and it corrected. But notice it did respect the 200-day moving average. We keep coming back to the 200-day moving average. Got too high here, corrected. Got too high here, corrected. So, and again, right here, this end of the bull market still respected the 200-day moving average, and as you can see on Apple stock, hit that 200-day moving average and skyrocketed almost straight up, a parabolic move. So there's a lot of things going on here. I don't want to confuse you, but you can see that if you were in this stock here at 149, 150, all you had to do was say, did it close below the 20-day moving average? And the answer was no until this day right here on the 22nd. So you could have stayed in this stock from roughly 151 all the way up. Let's just average it out to 175. You could have took almost $25 out of this stock, and every morning just asked yourself, did it close below the moving average yesterday? If it did, I'm going to sell today. And that's all you have to do. So a 20-day moving average is a really simple way of following a stock. Now keep in mind, this is all for entertainment purposes only. This is all my opinion, and you're responsible for your own decisions. But a 20-day moving average can be very helpful in understanding the market. Maybe it's not going to be something that's going to make you rich, but it's something that's going to give you a really good yardstick, like a hammer to a carpenter. You got to know how to use it. So that's the basics of a 20-day moving average. And then the basics of the 200 is how it respects it. So what happens when it doesn't respect it? We see the price respected a 200-day moving average here, bounced off and continued to rally. What happens when it doesn't do that? It bounced off right here. But here it didn't bounce off. Here it went through and continued down, and we see that the 20-day moving average, instead of providing support on the way up, now it's providing resistance on the way down. And so this is when we formally call this price structure a bear market. This is a bull market. It's above the 200-day moving average, and it's respecting a 20-day. This is a bear market. It's below the 20-day, below the 200-day moving average, and it's respecting a 20-day. Respect just simply means it's bouncing off of it. Now, again, it can be a little bit ugly. It can be a little jagged. You can see right here it was a little ugly. This was particularly ugly. If you were short this stock, you wouldn't want to see that, but nothing's perfect. But if you try to optimize these and go 30-day, 40-day, you slow them down and they don't turn as fast. That's why people use the 20-day. It's just a compromise. But the point is that when a 20-day is going down and the price is below it, that's a good sign you probably shouldn't be in that stock. Again, entertainment purposes only, my opinion. Now you look, this stock was in, keep in mind this is Apple, this stock was in a bear market all the way through June of 2022 and turned up. Now this is a bear market rally. That means we're below the 200-day moving average. We're rallying, but it's still a bear market. But look how great it respected the 20-day. You could have got long this stock, hypothetically for entertainment purposes only, at about 139 and stayed long all the way up and maybe got out, but maybe waited until this day right here when it closed below the 20-day, August 22nd. And you could have potentially, again for entertainment purposes only, gone from 140 to, let's call it 170. It's a 30-day, that's a $30 price rise, and all you had to do was ask a simple question. Did it close below the 20-day moving average? And when it did right there, you get out of it. So you give up some money if you do that, or you can sell out here. There's all kinds of ways to do it. But you would have had a clue that it was starting to run out of gas on you, but it gets into much more technical details. We're speaking of simply a moving average and how helpful it can be if you just take the time to learn it. If you spread out, you'll see this really respected the 20-day moving average. Your close was right here below on the 26th, closed below the 20-day moving average. You would have sold out on this day if you followed the simple rules, and maybe you would have got out at the very low of this day, 157. But you would have got in maybe down here at 141, so $15. You could have got out of that without a whole lot of stomach ache, right? You're trying to avoid the stomach ache. Again, all for entertainment purposes only. So how can you use a moving average to get in the stock? It's simple. If the stock closes above a 5-day moving average, and it closes above a 20-day moving average, so let's just skip this one and go right to here. This stock closed above the 5-day moving average on the 6th of July, and it closed above the 20-day moving average. So we look at the close. It was $142.92. The next day, we'd look and see if we could get in at that price. Now, we couldn't. So what we have to do is use that price the next day and get in. That's how you can use this is a simple trading program. Take the close of the previous day, and then let's say today is the 7th of July. We would say, okay, we're going to get it at 142.92. And today it didn't hit it. It went to 143.28. But you keep doing that until you can get in. So this closed above the 5-day and above the 20-day, and it closed at 148.47. So today, let's call today the 15th of July, we could get in there at 148.20, so we could get in there because it closed lower than it traded lower than our close the day before was 148.47, and today our low was 148.20, so we could have got in. And so if we got in at 148.20, let's just call it 148.50, we get in there, so we're long the stock 148.50, and now all we got to do is stay long until it closes below the 20-day moving average, which it did here, and we get out worst case here at 158, and you do the math, you make 12, 15 bucks without a whole lot of brain trust and without spending a fortune on research. So moving averages, despite what people will tell you, are extremely helpful. Does it take a long time to figure all this out? Yes, it does. I'm not saying you can learn this today, but it's a very, very good indicator to keep an eye on and a very good way of looking at the markets, even if you don't use them to trade. And keep in mind, you trade at your own risk, and everything I've just told you is for entertainment purposes only. You have to trade at your own risk and do your own analysis. And all this is just my opinion. Now, that's technical analysis, moving averages for trading strategy. Very simple one, just the beginnings of it, and not by any way, shape, or form a complete discussion. Let's go down here and take a look and compare and contrast what we do at RMM Research. These are all algorithmically generated prices. Now we have Apple here. We were looking at Apple up top here, and we cover Apple on our algorithmically generated prices. These come out every day, Monday through Friday, and we have this. It's September 12th. We put these out already in the evening, and these are out for tomorrow morning, the 13th. We put them out for Apple, and tomorrow it says 0, so there's no recommended price for Apple, but normally these will be populated, like you can see Macy's and General Electric are populated down here. This system gives you a defined entry price and then a hold period. You just select. So one day hold would mean get in today, close out just before end of trading tomorrow at a loss, or get in at the price and take your profits as soon as you get them. So this is comparing algorithmic trading to the moving average trading strategy we just discussed. So these give you exact entry prices. You could also get an exact entry price up here by just simply using the previous day close, as we discussed. So just different ways of doing the same thing. Keep in mind, everything on here is for entertainment purposes only. These are just for entertainment, and you have to do your own analysis. You can't use our entry prices for anything but entertainment. But you can tune in to our website every morning before 7 a.m. and get the updated prices for 190 stocks and compare them to your own work and see what's going on between the two. Again, these are worst case holding scenarios. You take your profits as soon as you get them if you do, and worst case close out at a loss at the end of 1, 5, and 20 days. Now let's go down here and take a look at a beta system that we don't have up. All these are up, but this beta system is not up. This is a 30-day hold moving average trading system that'll give you a buy, flat, or short position. So we've taken moving averages and built an algorithmic trading system with it. These were for today, these are expired, but you can see it gives you an entry price exact, and it also says whether you should go buy flat or short. And you can see that it's got a negative sentiment on the market today. It's had short positions on everything. Tesla, we know what that price should be. Tesla just split, so we keep that price out of here. But it'll come up here in probably in another 7 or 8 days. But in general, you can build algorithmic trading systems that use moving averages, and that's exactly what this is. I told you I'd show it to you, and I'm showing it to you, even though this particular sheet is not available yet on our website. The ones I showed you up here, the 190 stocks, are available, and you can get them at rbamresearch.com, absolutely free, no credit card required, and you can compare them to your own moving average work and see what you think. For entertainment purposes only, we cover 190 stocks, we cover the major forex pairs, we cover BTC crypto, and we cover the most liquid futures contracts. These are all our algorithmically traded prices that we put out before 7 a.m. Again, rbamresearch.com. There's a link in the description below, and again, they're 100% free with no credit card required. You should always do your own analysis, and moving averages are a great way to do that. If you like this video, please click the like button. If you want to subscribe and see more, we're putting out quite a few every week. Please hit the subscribe button. We'd love to hear your comments in the comment section below on whether you like technical analysis or you don't like it at all. Please let us know one way or the other and why in the comments section below. We'd appreciate it. We want to improve these videos. And keep in mind, everything you've seen or heard on here, including our entry prices and the commentary, is for entertainment purposes only. You have to do your own analysis. You can't use ours for anything other than entertainment, including our entry prices, and you definitely trade at your own risk.